Is it time to move away from the coveted S&P 500 and invest a little closer to home in the FTSE 100? Both of these indexes have broken their all-time highs multiple times this year. But which one will outperform going forward? At first thought, you may think this is not even a comparison. The S&P 500 has massively outperformed the FTSE 100. And over the long run, you'd be right. But there is a lot of nuance around currency risk. And more recently, there is a little bit of a different story. This is looking back over the past 15 years, starting in 2010. And if you invested in the S&P 500 then, your investment right now would be up 676%. Compared to the FTSE 100, which is only up 208%. This is a huge difference, especially for two well-developed nations. But let's have a look at some of the reasons why this difference might be so large. The first is currency risk. And as a UK investor, if you invest in the S&P 500, that means we have to take our pounds and convert them to US dollars in order to buy US stocks. And looking at these graphs, you can see from 2010 to around 2014, they are fairly level. And then from about mid-2014, they start to diverge, and that gap gets ever bigger. But not only does this coincide when the large tech stocks started to boom, but there was also a big currency differential right here. In the middle of 2014, the exchange rate between the pound and the dollar was sitting around 172. This was when the talk of Brexit started to happen, and from here the pound actually fell all the way down to around 116. It has recovered since, and you can see that it's fluctuated, and it's sitting currently around 135. But this is a massive drop from where it was in 2014. And as you can imagine, if you're investing into US stocks, you've converted your pounds into dollars. So when that pound starts to fall against the dollar, you're protected against that because you hold your investments in dollars. Hence why that graph starts to diverge more from that period. However, when we look at more recent times, it is a very different story. So over 5 years, the S&P 500 has returned around 99%, compared to the FTSE 100 around 85%. So the S&P 500 still has outperformed, but it's by a much less margin. It gets even closer when we look over the past year, with the S&P 500 performing 18%, the FTSE performing 16%. And actually, when we look at year to date, the S&P 500 has actually only returned 3%, compared to the FTSE 100, which is sitting at 16%. And that currency risk is actually reversed. At the start of the year, in January, the exchange rate was sitting around 1.2. Today, it's sitting at 1.35. If you invested in the S&P 500, your pounds would have been converted into dollars in order to buy US stocks. But then the dollar has actually weakened against the pound. So your investments, which are valued in the dollar, would have weakened against the pound which you hold in your home country. This is why it could be quite alarming for UK investors right now who hold US stocks, because you see the S&P 500 hitting new all-time highs. But then you look at your portfolio and wonder why it's only up 3% this year. And it's down to that currency risk you take on when you invest in stocks abroad. You may also look at the UK right now, especially the economy, and wonder, how is the UK stock market consistently hitting new all-time highs? And this is a common misconception between the economy and the stock market. The FTSE 100 is also so internationally diversified. The companies in this index get their revenues from all over the world, so it's not the best reflection of the UK economy. If you look at the FTSE 250, which is the next 250 companies after the FTSE 100, that is a slightly better reflection of the UK economy. And that's because a lot of the companies in this index are slightly more domestically focused. Now let's talk about valuations. And when you hear people talk about the S&P 500 recently, you may have heard them talk about it being expensive and it's being overvalued. And what they're referring to here is the price to earnings ratio. And what this essentially means is the price an investor is prepared to pay for the earnings of that company. So if the price of a company moves up faster than its earnings per share, it may be perceived as being expensive for the potential earnings of that company. When looking at PE ratios, they're usually a snapshot of what's happened in the past. So they take the price and divide that by the earnings per share over the past year. But actually, we should look at forward PE, which takes the price and then divides it by projected earnings moving forward. Because when you invest into a company, you want to value it based on what it's projected to do in the future. The forward 12-month PE ratio for the S&P 500 is currently sitting at 22.1 compared to its 10-year average of 18.5. It is slightly harder to get data on the FTSE 100, but as of the 1st of July, it does have a forward PE ratio of 12.48. So you can see the valuation gap is absolutely huge, but so are the type of companies. On one side, you've got high growth tech companies with dominant positions in AI and cloud computing. On the other side, you've got mature dividend paying companies in sectors like energy, healthcare, financial and consumer staples. Based on these differences, you could argue that the valuations are justified. But you could also quite easily argue that even for tech companies, these valuations are stretched. It all depends on your perspective. Tech companies will typically reinvest their profits back into the business for growth, which does mean lower dividend payouts, whereas FTSE 100 companies tend to be more mature, cash-generative businesses. They may have fewer higher growth opportunities, so they tend to return a larger proportion of profits to shareholders in the form of dividends. And you can see this in their current dividend yield, with the FTSE 100 sitting at 3.29% and the S&P 500 sitting at 1% exactly. And this is really important because it will affect volatility. So even when we look at the weightings of these two indexes, they're both heavily weighted towards their top 10. In the S&P 500, the top 10 makes up around 36.54%, and in the FTSE 100 it's even higher at 44.76%. So in both indexes, there is a lot of concentration risk because they're both market cap weighted. Those large companies make up the large majority of the returns in the index. But when you have companies that pay higher dividends, they tend to be less volatile. They tend to be your consumer staples, so more defensive stocks. So in market downturns, they tend to sell products and services that people need, regardless of how the economy is doing. They won't get the same growth as tech companies like the ones in the S&P 500. So when markets are really booming, currency risk aside, they won't get that explosive growth. But when the market downturns and there are recessions, they will perform slightly better. So it all comes down to your perspective and what you think will happen with growth in both markets, and also where you think currency will move. I always like to use this graphic when I compare US performance to the rest of the world, because it's important to see how the markets have moved in cycles. And we can look over the recent past, in the past 15 years, and the US has outperformed the rest of the world. So it's very easy to think that that will always continue because we have a recency bias. Actually, when we zoom out and look at the bigger picture, have been cycles and have been a lot of periods where US has outperformed in some years, but then also it's underperformed in other years. This is not to say just because the US has outperformed for a long period of time, it's suddenly going to underperform. It could carry on outperforming. It's just important to take this into account and have perspective when you look at the bigger picture. You could also have a balanced approach as well and invest in both of them. You could have an even more balanced approach and invest in the global market, which includes both of these indexes. I like to create a little bit my own global index where I take what the index currently is for the world, and I then like to underweight or overweight depending on where I think things will move. The US makes up such a massive portion of the global index, currently sitting around 62%. And in my view, that is slightly overweight from where I want to be. So by creating my own portfolio, I can reduce that exposure slightly to the US and increase exposure in places like the UK, Europe, and emerging markets. Let me know if you have a strong view one way or the other. Are you going down the S&P 500? Are you going down the FTSE 100? Have you got a bit more of a balanced approach? Or are you just sitting back, investing in a global index fund and not have to think about it? If you need any guidance with your long-term investing portfolio, I do offer one-to-one personal coaching, which you can find out more using the link down below. I hope you found that useful. Drop it a like if you enjoyed it, subscribe if you're new, and I'll catch you in the next one.